Hi everyone, thanks for joining today's webinar. My name is Jacqueline Jackson. I am a portfolio administrator for the Center for Financial Planning, and I hold a Chartered Advisor in Philanthropy designation. Fortunately, I'm also a member of Impact 100 Metro Detroit, and today I'd like to help you develop meaningful relationships with donors by first providing insight on what donors want to know before working with charities, telling you how to make it easier for donors to support your work, and show why endowments are important for meeting your organization's goals. Here's how I'd like to accomplish that. First, I'd like to provide feedback from the Impact 100 Metro Detroit grant selection process. Second, I want to share tips for working with individual donors and financial advisors. Before we get started, I know you're familiar with Impact 100, but I want to tell you a little bit about the Center for Financial Planning. The Center is a wealth management firm for generations. We are a team of roughly 30, including 12 certified financial planners supported by investment, client service, and operation professionals. Over our 33 years of business, we've grown to manage $1.2 billion in assets. Most importantly, every penny we manage represents the possibilities and goals of our clients whom we cherish greatly. We partner with individuals and families to help them move forward with their financial goals. So this is our agenda for today. We have a lot of ground to cover, so I'm going to jump right into it by explaining what donors want to know before working with a nonprofit. As an Impact 100 participant, I was a part of the Grant Review Committee and the Financial Review Committee. My hope is to give you a peek behind the curtain and a feel for key factors that stood out in committee discussions. The Grant Review Committee used a point system to score each of your application answers. The applicants that received the highest cumulative scores moved on to site visitations and further review from our financial committee. The best applications communicated importance, credibility, capability, and feasibility. So let's break these down, starting with importance. The question here is, how do you get the donor's attention? The best way is to be innovative. You want to ask yourself, am I presenting a unique solution to a tough problem? Is someone else doing the same thing or something similar? Does my proposal complement or duplicate the work that's already being done in this area? Keep in mind that complex problems require many solutions, so grantors are not interested in using resources to duplicate efforts. In addition to innovation, you really want to make sure that your goals align with the grantor's goals. You're looking to build a long-term relationship with grantors, so it's really important that they are just as committed to your cause as you are. Otherwise, it's not a good match and it won't last for the long haul. Let's think about it like a pair of shoes. You wouldn't pair a dress shoe with a gym shoe because each shoe serves a different purpose. How long would you be able to walk around with two different types of shoes? Not long, right? Likewise, a misaligned relationship won't last very long. It's a waste of time and energy for your organization to try to force a relationship. You may get some funding initially, but it won't be long before that partnership falls through. Also, a dramatic falling out with a grantor could potentially tarnish your reputation. Speaking of which, let's discuss credibility. Successful applicants did a great job of communicating their organization's legitimacy. For all of them, that looked like demonstrating an expert-level understanding of the problem they want to solve. It's the difference between saying you want to start a tutoring program and saying you want to start a tutoring program for a specific demographic or grade level because you understand the correlation between that specific group of students and high school dropout rates. In your application, you want to clearly identify the problem. Talk about your organization's track record and commitment to solving that problem. Also, you want to highlight key leaders or key team members that have relevant areas of experience and expertise, or relevant training, or relevant education. Next, successful applicants took the time to explain a comprehensive and detailed plan of action. You need to show donors that your proposal is an effective solution to the problem. Our third grade teachers gave us the best advice here. Always include the who, what, when, where, why, and how of your proposed program. It's really simple advice. It sounds silly, but you'd be surprised how many applicants take for granted that donors know what they know, and that's not always the case. So make sure you provide detail. Spell it out. Make the outcomes of your proposal clear. Include measurables to demonstrate the impact of your proposal. Another component of credibility is your network and reputation. A few questions to consider are, do you play well with others? Do you collaborate with other organizations to reach your goals? Are your other programs or past programs reputable? Can peers or your community vouch for your organization? Have you won any awards? It's a relief for grantors to see awards on your website because it shows a third party can vouch for your credibility. Let's talk about being capable. Being a capable organization means that you have the right people and structures in place to facilitate your program. In short, you're a well-oiled machine. In applications, you want to make sure you communicate how long you've executed this strategy. It's nice to hear about lessons learned or how you've evolved your program over time. If the proposed program is new, discuss what you've learned from previous work in the field and how that experience will support a positive income for the new program. Relating to credibility on the previous slide, it's also helpful to know any outside experts' confirmation of your strategy. That may look like research or third-party evaluation of your program. Likewise, the committee appreciated when organizations had a clear plan for program evaluation or comprehensive strategies to gauge the program's effectiveness. Lastly, the best grant applicants provided sufficient evidence that they have stability, adequate staff, and structures in place to sustain the program over time. It's really important. Moving on to feasibility, it was really important to the Impact 100 Grant Review Committee that your project goals and expectations were realistic. In terms of funding, I want to talk about shared risk a little. By that I mean the Grant Review Committee rated organizations that had multiple funders higher than organizations that relied too heavily on one or two donors. So for example, we didn't want to see 70% of funding coming from one donor. Grantor diversity helps donors see that the program has the capacity and stability to continue even if an individual funder drops out. We also rated application answers higher when they communicated how the proposed work, schedule, staffing, and budget were on target to meet goals. In summary, for the grant review process, get the donor's attention by communicating importance. Explain your organization's legitimacy to indicate your credibility. Discuss the people and structures you have in place for your proposal to demonstrate capability. And lastly, prove that the proposal is feasible by showing realistic goals and expectations. Now we're going to move into the financial review feedback. So as a committee, we really relied on information from your 990s to assess your financial organization's financial health. My key advice for applicants is very simple. Make sure you submit this information. I'm going to repeat it. Make sure you submit this information. Frankly, we couldn't continue the review process for applicants missing 990s, no matter how much potential the proposal had or how excited we were about it. Providing access to 990s demonstrate transparency and honesty. In this presentation, I really wanted to highlight Charity Navigator's financial health evaluation because many individual donors rely on this website to assess nonprofits and decide whether they should give to organizations. Charity Navigator has efficiency performance metrics as well as capacity performance metrics. I'd like to share 3 of the Charity Navigator metrics that the Impact 100 Financial Review Committee also used to evaluate your applications. The first metric we'll discuss is the program expense percentage. Essentially, this takes your average program expenses and divides it by your average total expenses. By doing this, we want to better understand how much you're spending on programming that fulfills your mission. If the percentage is high, we can see that a lot of your organization's spending goes towards programming and mission fulfillment. And that's what we want to see from the organizations we support. Charity Navigator believes that nonprofits spending less than a third of their budget on program expenses are not living up to their missions. So you want to make sure that you're not spending less than a third of your budget on program expenses, because then you would not be living up to your mission. The second metric we'll discuss is the fundraising expense percentage. This takes your average fundraising expenses and divides it by your average total expenses. And when I say average, Charity Navigator uses a 3-year averaging. So that's what I mean by average. In this case, we're assessing whether too much of your financial resources are going towards fundraising instead of programming. Ideally, we want this number to be relatively low because donors would prefer that most of their donation goes towards mission-fulfilling programs and not fundraising. According to Charity Navigator, a public broadcasting or media charity shouldn't have a percentage that's higher than 35%. A community foundation or food bank or food distribution nonprofit shouldn't have a percentage higher than about 20%. And then a grant-making charity shouldn't have a percentage higher than about 25%. The third and last metric we'll discuss is the working capital ratio. This takes your working capital and divides it by your average total expenses. This number helped the Financial Review Committee identify how long you'd be able to sustain your current programming without any new revenue. More years or longer periods of time indicated more financial stability and showed your ability to sustain revenue through rough patches. So your numbers. During the financial review process, we contacted applicants to ask follow-up questions about numbers that didn't make sense to us or that were missing information. The best applicants readily provided 990 forms and information, knew their numbers, and could explain them. It's important to note, applicants who could legitimately articulate why a number appeared off weren't eliminated from the selection process. So clearly the takeaway is knowing and understanding your numbers. That matters tremendously to donors. Work with a CPA to get a secure grasp on your numbers. Hopefully you have a better perspective on what the grant and financial review committees like to see from applicants. To make things clear, I also want to highlight what hurt applicants during the review process. So if you were missing plan details, that hurt your application. Missing or incomplete financial statements hurt your application. If we weren't sure that your team demonstrated the skills needed to execute your proposal, it hurt your application. If we weren't clear that you showed knowledge of best practices, it hurt your application. Also, if we had questions about leadership or board data, that also rose eyebrows. So organizations that avoided these missteps made it very far through our due diligence process. So if you can avoid these, you'll probably be pretty successful in our process. So we are on the second part of our agenda. Now that you have a better understanding of Impact 100's grant review and financial review committee's do's and don'ts, I want to shift gears a bit and discuss how you can make it easier for individual donors to support your work. So far, we've discussed ideas about how to appeal to institutional donors or giving circles, but because it's important to diversify your donor base, I want to give you insight into how financial advisors are telling their clients to give. If you understand how individual donors give, you can design fundraising campaigns that work with those giving strategies and make it easier for donors to give to your organization. The two commonly recommended giving strategies are donor advised funds and qualified charitable distributions. A donor advised fund is an account that allows donors to make a charitable contribution with the benefit of receiving an immediate tax deduction. Donors can contribute to the account as frequently as they like and make grants to their favorite charities whenever it makes sense for them. Donors and advisors like this strategy because it provides a tax deduction for donors the year the contribution is made. Donors can give appreciated securities and avoid paying capital gains tax on those securities. The assets in the account are invested and can grow over time, which creates more meaningful gifting opportunities for donors. They can donate more, possibly. And donors can make grants to charities whenever they are ready, so they have time to build rapport and relationships with your organizations before they give. The second giving method is appropriate for donors who are 70 and a half and are taking required minimum distributions from their tax-deferred accounts like IRAs, SEP accounts, and simple IRAs. For some people, the additional tax income from taking required minimum distributions could push them into higher tax brackets and could reduce their eligibility for certain tax credits and deductions. So if someone is inclined to donate and wants to avoid being pushed into a higher tax bracket, they can make a tax-free distribution from their IRA directly to a public charity to satisfy their required minimum distribution. In other words, they can pull the amount of money they are required to take for their retirement accounts and give it to a charity instead of taking it for themselves and increasing their taxable income. This is called a qualified charitable distribution. Also, donors are not limited to giving their required minimum distribution amount. They can donate up to $100,000 per year tax-free. This is a brief overview of two commonly recommended giving strategies. If you have questions or want to learn more, reach out to our team at the center, and we're more than happy to help. Likewise, if a few of your donors are coming to mind, and it sounds like they would benefit from these strategies, we can help your donors determine what makes the most sense for them. All right, moving into the last part of our agenda, we're going to discuss ways to meet your organization's goals. I have the pleasure of coordinating this event with Impact 100's Recruitment and Outreach Committee. One of the committee members recently retired, but was a career fundraiser for nonprofits. She told me an awesome story of how an anonymous donor requested a huge donation to her organization at death, and her organization was able to use that bequest to start an endowment. She found that the endowment elevated her organization and asked me to discuss them in this presentation. So what's an endowment and why is it important? I thought this description of endowment summed it up pretty neatly. Endowments may generally be described as cash accounts that are invested in equities or bonds or other investment vehicles. Assets are set aside so the original assets in the account, known as the corpus, grow over time because of income earned on interest on the underlying invested funds. The corpus may also be added to over time. Endowments are commonly used by large institutions such as universities and hospitals, but they may also play a role in any charitable nonprofit's financial management and/or revenue strategy. In the context of what donors want, an endowment can represent financial sustainability for nonprofits. That really matters to donors because they want to support organizations that have the longevity to carry out their mission. Key players involved in managing endowments are a board of trustees who have the final say on endowment decisions, an investment committee who creates an investment strategy, a fund officer who's a member of the investment committee and appoints a fund manager, and a fund manager who's actually selecting and investing the underlying investments in an endowment. As with most things, starting an endowment requires serious thought and consideration. They can be pretty expensive to manage. It takes a lot of time and energy to mandate and monitor. And developing nonprofits that still have immediate needs for funding may not be ready to put aside assets into a less liquid form. If this is something you want to do, I want to stress that you work with a registered investment advisor to explore the costs and benefits of having an endowment. Nonetheless, there are many benefits to having an endowment. 3 major reasons from this list are: they can create an ongoing source of income for your organization, they can give your organization independence from relying on government resources or being vulnerable to economic and political forces, and they help create a pipeline for future gifts. Because I work for a financial planning firm, I was also asked to discuss ways nonprofits can work with financial planners. Often, the clients financial planners serve are the same individuals that have the ability to make meaningful contributions to nonprofits. So it makes sense that nonprofits would want to build relationships with financial advisors who have clients that are inclined to donate, have donor-advised funds, or give qualified charitable distributions. The best and most natural start may be to ask board of directors to reach out to their advisors on behalf of the organization. It's a pretty soft lead for you. Additionally, fundraising events that financial planning firm clients would want to attend create excellent opportunities to collaborate with financial advisors. For instance, the center has sponsored wine tasting, fashion, and performing arts events thrown by nonprofits and invited our clients to those events. Our clients were exposed to nonprofit organizations in a fun way, and the center was happy to donate to worthy causes. Not to mention, if we receive positive feedback from clients about the events, often the center collaborated with those organizations several times thereafter. So since we're discussing events and ways to work with financial planners, I want to share an opportunity to collaborate with the Center for Financial Planning on a client event. For now, we're playfully referring to our fall charitable giving event as our Shark Tank event. For this event, clients will be briefly trained on how to identify a great nonprofit to support. Then our clients will be pitched by 2 nonprofits, sort of like the sharks on the popular show Shark Tank, and will be tasked with figuring out which nonprofit they want to support. So we're looking for 2 nonprofits willing to pitch their organization to our clients. This is a part of our Center Cares initiative, so luckily, both the nonprofits will be rewarded a gift for participating. If you're interested in participating, please email contact@centerfinplan.com with the subject line Philanthropy Event Interest, and we'll follow up with you and give you some more details about the event. All right, everyone, we've made it to the end. I hope you were able to grab a few nuggets from the presentation. We thank you for participating in this year's Impact 100 grant application process, and we wish your organization continued success. As always, if you have any questions, feel free to email me at jacqueline.jackson@centerfinplan.com. And again, thanks for joining me and enjoy the rest of your day.